Welcome to this training on divorce and taxes. What you need to know for 2025. I'm Jayden Doyé, CPA. Whether you've recently gone through a divorce, you're supporting clients through a separation, or you're simply preparing ahead for tax season, this session is designed to guide you. We'll walk through the most important updates, key decisions, and common pitfalls so you can keep your tax filing clean, compliant, and fully optimized. Let's get started. Let's start with filing status because this is where many mistakes happen. Your marital status as of December 31st determines how you file for the entire year. If your divorce is finalized by that date, you can file as single or possibly head of household if you qualify. If it's not finalized, the IRS still considers you married, meaning you'll need to file as married filing jointly or separately. It sounds simple, but this is one of the most commonly misunderstood rules after separation. Next, let's talk about dependents. Only one parent can claim a child on their tax return, even in a joint custody situation. In most cases, it's the custodial parent, the one the child lives with for the majority of the year. However, that right can be transferred if the custodial parent signs Form 8332. It's important to clearly document custody time and agreements, because this is a major audit trigger when done incorrectly. If you and your former spouse made estimated tax payments while still married, those payments need to be properly divided. There's no automatic rule that says it's a 50-50 split. Instead, it should follow whatever agreement you both made. The key here is documentation. Make sure everything is clearly outlined in writing to avoid future disputes. And remember, each person should only claim the portion that actually belongs to them. Now let's look at property transfers. When assets, like a home, are transferred between spouses as part of a divorce, it's typically not a taxable event. However, timing is critical. To qualify, the transfer must happen within 1 year of the divorce, or be clearly outlined in the divorce agreement. But if the home is later sold, that's where taxes can come into play. Capital gains rules, ownership, and residency all affect how much, if any, tax is owed. Alimony and child support are often confused, but they're treated very differently for tax purposes. If your divorce was finalized after 2018, alimony is no longer tax deductible, and it's not considered taxable income for the recipient. Child support, on the other hand, has never been deductible, and it's never taxable. This is why the wording in your divorce decree matters. How payments are labeled can directly impact your tax outcome. Some payments during divorce don't go directly to your ex, but they can still have tax implications. For example, if you're paying rent, tuition, or medical bills on their behalf, those payments may qualify as alimony, but only under specific conditions. On the legal side, most divorce-related fees are not tax deductible. The exception is tax-related advice, such as consulting a CPA or tax attorney, which may qualify. So it's important to separate personal legal costs from tax-specific ones. Let's quickly go over some of the most common mistakes. Claiming the wrong filing status. Both parents claiming the same dependent, forgetting to use Form 8332, misclassifying alimony, or not adjusting estimated tax payments. These issues can lead to delays, penalties, or even audits. The good news is, most of them are preventable. Spending just a little time reviewing your records now can save you a lot of stress later. Taxes after divorce can feel overwhelming, but they don't have to be. If you need help navigating your filing status, dependents, alimony, or any of the changes we covered today, we're here to help. You can book a consultation by scanning the QR code. Let's work together to make sure your tax return is accurate, compliant, and fully optimized.